behavioral finance is kind of a fun and interesting field here. Um, here we're talking about the interplay between the markets and humans, right? Much of the theory that was developed and that we still use today was developed in a world prior to the idea that we could have behavioral finance as a field of study. It really didn't come into being until probably 30-ish, 35 years ago. Much of the theory that we use still today was thought about and developed 50 or so, 40 years ago. So if it looks like it's kind of tacked on to to everything, yeah, it is. And in fact, there are still a lot of people in finance that don't think that behavioral finance is even a legitimate field of study. I don't happen to be one of those people. I think that it has some validity and is worthwhile. And in fact, I'll tell you, where'd my book go? This, if you're looking again, kind of looking for a read or anything, I've already talked about Fooled by Randomness and Random Walk Down Wall Street. This book by Daniel Kahneman is really worth taking a peek at. Thinking Fast and Slow. Danny Kahneman and Amos Tversky are two of the people. Both should have won Nobel Prizes. Unfortunately, Amos passed away, I believe, prior to the Nobel Committee recognizing their work, and they don't grant Nobel Prizes posthumously. So Tversky didn't get the prize. Kahneman very clearly made it that it was a joint work between the two. That's also this book. He mentions Tversky quite a bit in the book as well. So these two gentlemen, both psychologists, by the way, actually were pivotal in developing this field and bringing it into what it is today. They did a lot of the groundbreaking work, especially on the psych side of things and how it might impact finance. So traditional finance, again, I'm in the way, has taken the view, this is the 50, 40 year ago theory, has taken the view that there is a financial actor, an individual, and that individual is a rational investor. So we've developed these models with the assumption that all individuals and all investors are rational. Or if there are a few that aren't, at least most of them are, and those few irrational investors won't affect the market. And these models, these asset pricing models, so we're talking CAPM, we're talking about the Black-Scholes option pricing model, portfolio theories, which is modern portfolio theory, MPT. All of these were developed in that world, in that rational man world, rational person world. So the two very important assumptions that were underlying this is that not only were people rational, but they were unbiased in their predictions. In other words, I wasn't always, more afraid of losses than gains or something like that. And fact is that people like Danny Kahneman and Amos Tversky started questioning these assumptions and saying, well, you know what? We study human behavior. Humans are not like that. So I don't care what you say, that your models won't be tractable with the other assumptions. We need to deal with this. People often make and act irrationally, and they make predictable errors over and over and over again. So the real question, though, is do these behaviors, do they actually impact the pricing in the capital markets? That's the only time it really matters, is if that does affect pricing. So necessary conditions, and again, I should have been more careful with my slides here. I'm getting all over my text. So if enough of us act rationally, on one or more of our biases, and the biases don't cancel each other out, and most importantly, there are limits to arbitrage, then it could be that these behavioral aspects that we walk around with in our brains that are kind of hard-coded into us, those might affect prices if these situations exist. Who cares? Well, we should all care because, we're using things like CAPM. Even the practical world, the professional investors use CAPM, and that has that assumption embedded in there. Just found this a few months ago. There's a really nice lecture here by Robert Shiller. He, too, is a Nobel Prize-winning economist and talks about this idea. I'm sure you've all heard of irrational exuberance, right? That's what he argued happened back during the financial crisis. It was basically people were thinking housing prices are going up and they're going to continue to go up. I remember talking to people, family members who are going, oh, yeah, I want to buy a house. I'm going, well, housing prices are really high now. Why do you want? Oh, because they're going to keep going up. Oh, okay. My sister, for one, actually got stuck with a fairly hefty mortgage that she lost a lot of money on. So, it's this sort of irrational exuberance that things will go on, or that I can find a bigger fool to buy my house at 30% above what I already paid too much for. And so Shiller is kind of at the heart of some of this. And this relates directly, obviously, to behavioral finance. So I'd strongly recommend a peek at Robert Shiller. He's an interesting guy. By the way, it's Shiller and Jean Fama who were awarded, I think I mentioned this in a prior class, but if not, Jean Fama, that there are no bubbles, and Robert Shiller, Mr. Irrational Exuberance, were awarded the Nobel Prize in Economics in the same year. So the Nobel Committee, at least in the economics, has a sense of humor. They pit these two guys who kind of hate each other against one another. Okay, so let's start talking about some of these various types of psychological aspects that we have. So this was apropos last year, right? If you could find toilet paper, you would grab it no matter what the price was. But let's suppose that we found a big sale on toilet paper. That may be the case now, right? Because everybody's hoarded it and nobody wants to buy it, so they put it on sale. It's 20% below the normal price. What do? Well, of course, we buy a case of toilet paper because, this is a good price. Trouble is that when we look at a stock, we own 100 shares of Boston Scientific. More news comes out and Boston Scientific stock drops 20%. What do? Well, instead of buying more, we kind of go, oh my God, maybe I need to get out of Boston Scientific. Now, if this news is systemic and is likely to be followed by more negative news, then yeah, the answer is get out of Boston Scientific. But that's not necessarily the case. It could be that it's just a blip on an otherwise very, very strong growth pattern for Boston Scientific. So when you see price drop, that's not always negative. That might be a buying opportunity. So prediction and precision are issues that we contend with quite frequently. And we actually overestimate our ability to predict things with a particular level of precision. So we're gonna test this out, see how you do here. So I've got a series of questions. So I hope you all have a piece of paper, and I'm going to ask you to come up with a couple with ranges for each of these questions. There are 10 questions that I have, and what your goal is with these 10 questions, you would like at least 9 of your ranges to contain the actual answer. Okay? So that would be 90% accuracy. with a 10% error. So 9 questions where the actual number falls within your range, and 1 question where it falls either side. We don't care which. Now, the idea here is not to create ranges that are just ridiculously wide, because then why would I need an analyst? I mean, if I said, you know, the average weight of a blue whale in pounds is, well, it's between 0 and infinity. Yeah, that's not very helpful. So make sure that you use your confidence in your answer to gauge how narrow or wide to make that. If you're fairly confident, make the range relatively narrow. If you're not very confident, make it a little bit wider. Try to be reasonable, though. I mean, obviously, we know a blue whale, it's bigger than an elephant. What's an elephant weigh? I don't know, 1,500 pounds. So it's probably, that's the minimum. What would the maximum be? You know, you get the idea. So out of these 10 questions, write down a range for each one, and then I'll show you the actual values, and you'll give yourself a point for each one that you that falls within your range. So the first one is, what is the average weight of the adult blue whale in pounds? In what year was the Mona Lisa painted by Leonardo da Vinci? Not a trick question. Yes, he did paint the Mona Lisa, but what year? So give me a range. How many countries were members of the UN in 2017? What's the air distance in miles between Paris, France, and Sydney, Australia? How many bones are in the human body? Well, let's see. 1, 2, 3. You know, you can come up with a rough minimum. How many total? But here's one that probably will be a much wider range, right? How many total combatants were killed in World War I? Just combatants, not civilians. How many items, including books, manuscripts, microforms, sheet music, etc., were in the Library of Congress at the end of 2016? How long in miles is the Amazon River? How fast does the Earth spin at the equator? So if you were standing on the equator and we're considering relative to the poles, how fast would you be moving in miles per hour? And then finally, how many earthquakes per year does the National Earthquake Information Center locate and publish information about on a global basis? So everywhere on the planet. So jot down the ranges. Again, like I said, if you're fairly confident, you can make it a relatively narrow range. If you're not so confident, make it a wider range. Okay, so now let's move on to the answer phase. 250,000 pounds. I apologize. I may have anchored you on that one, so sorry. My bad. 1513 was the year that Leonardo da Vinci painted the Mona Lisa. 193 countries, 10,543 miles between Paris and Sydney, 206 bones in the human body, 8.3 million combatants killed in World War I. That's pretty astounding. I mean, just horrible number. Wow. 164 million items in the Library of Congress. 4,000 miles is the length of the Amazon, and 1,044 miles per hour is the speed at which you'd be traveling relative to the pole if you stood at the equator, and 20,000 earthquakes annually around the world. Okay, so I'm going to count up the number that the actual fell between your minimum and maximum range. And here's a poll. You can log in with your number of questions that the actual fell within the range. And then I'll share this with everybody once I've got all the answers in. All right, here we go. All right. So interesting. Hey, I think this is a record setter here for this class. I've never had anybody get 8, much less 7. Even 6 is pretty darned good. So here we go. We've got 3 people that got 6 or more that the actual fell within their range. That's incredible. Really is, honestly. I usually I start down at around 6 or 5, where I get somebody with that many that fell within their range. 8, I don't think I've ever seen that. So congrats. Who's the 8? Who is the 8? Anybody willing to confess on that one? Nobody? Come on. This is anonymous, but all right. 8 people got 5, which is really incredibly good too. And then 4, 2, 5. So what are we up to? 9, 11, 19, 20, 21, 22. You've done well. Let's go, though, to one more question that I have for you all. Knowing that some of you are really good and that the rest of you are pretty much like the average population, I've got one more question that I want you to put a range on. Okay, in 1929, the Dow Jones Industrial Average started the year at 300. Okay, by the end of 2016, it had reached almost 20,000, 19,787. Now, the Dow does not include dividends. It's simply capital gains. And we know that dividends amount to 2 to 3%, somewhere in that range. Virtually every Dow stock has paid dividends. So what I want you to do is to estimate a range that were you to include dividends over that same period of time from 1929 to 2016, starting at 300, what would the Dow be in 2016 if it were to include dividends? Remember, we've got compounding going on, and the longer the time frame, that's exponential, it's going to be big, right? But without dividends, it's at 20,000. What's the range once we add the dividends in? So jot down a low figure. Obviously, it's going to be above 20,000 by a fair amount, but then a high figure as well. And make that range consistent with your confidence that you know what or more or less where the answer will fall. All right, so here we go. Get over here. Including dividends, assuming reinvestment. I apologize, I didn't say that, but should go without saying. The Dow would be, anybody want to put money on this? No. Okay, all right. Anybody have a range that went up to 613,000? Pretty incredible, right? And that's the beauty of compounding, right? It's an exponential thing. So it's not surprising. Did anybody get anything up towards 500,000? No? Okay. Probably what, 60, 70,000 was your top end, 80,000, maybe even 100, thinking that, oh, that's way, way higher than it'd ever be. And I would agree. You know, if you don't actually sit down and do the math, it's really easy to make yourself think, oh yeah, this is the case. So this is prediction error and anchoring. By the way, I mentioned 20,000 a couple of times. I did that on purpose to try to anchor you on that 20,000. I wanted to make sure that, you know, and I also said 2 to 3%. And we're talking, what, a little under 100 years, 2 to 3%, 300%, you know, okay. So we'll make it the high end 100,000, you know, and it'll probably be more like 70, 80,000, right? At least that would have been my thinking. But this is the fallacy that we all fall prey to. Our brains cannot assimilate all of the information that hits us, right? So we have to have these shortcuts. And that's also, this fast and slow thinking by Daniel Kahneman. That's the fast thinking. Also, what other psychologists call system one thinking, where you see something and boom, your brain immediately reacts and says, yep, this is the answer. System two, or the slow thinking, you slow down and you go, wait a minute, hang on, let me do the math, or let me think that through a little more clearly. Because really, that isn't a tiger about to pounce on me. It's just a simple question. And maybe my fast thinking brain didn't quite figure it all out. So, and another example of this that I like to point out is the problem we had with Enron. So, well before most of your times, Enron was one of the highest market cap companies in the entire country. And for that company to go from that value to zero, imagine Apple or Amazon, or Alphabet, the parent company of Amazon, right? Imagine Alphabet going to zero in the course of less than a year. That's just unfathomable, right? Nobody thought that Enron could go down like Enron went down. Or think about the Dow, 2007. It had peaked out at 14,000. Granted, that's less than half of where it is today. But it went down intraday, down into the 6,000s. Who could have imagined that? Surely it can't go any lower than that. But, and people were saying that when it hit 10,000, 4,000 points off of 14,000. That's a pretty significant drop, right? It's not quite a third, but it's still, you're in definite decline territory. But for it to drop all the way down into the 6,000s, it dropped a little bit below 7,000 intraday. Just incredible shifts. So we have to recognize that these things can and do and will happen. Okay, so here's the other question. If I relaunch this, you'll still have to answer something on question one, but let's try this. You're really answering the second question now. How much does the ball cost? So we have a bat and we have a ball. Together they cost $1.10. The bat costs $1 more than the ball. How much does the ball cost? Don't take too much time. This is system 1 versus 2 thinking. Answer quickly. Going to give you another 30 seconds. I'll close it out. 3, 2, 1. All right. So let me share the results. So here we are. 32% of you said 5 cents. 68% said 10 cents, and luckily nobody said 15 cents. The correct answer is 5 cents. Can't be 10 cents, right? Because then the bat wouldn't be $1 more, it would be 90 cents more. So it's got to be 5 cents. And this is an example straight out of Kahneman's book here about how our fast brains work. Is that you see that $1.10 and then it goes, the ball's got to be 10 cents, right? Yeah. No. So we all fall prey to these things. And the point of these exercises is to show to ourselves that we do face these things. And for instance, that Dow Jones Industrial Average example, even knowing that most of us, now there are some of you show-offs that got 7 and 8, but most of us are very, why am I losing my slide deck there? Most of us are very bad at estimating things like that. Yet we still didn't estimate that one with a wide enough range. Oh, by the way, just so you don't feel too bad, more than 50% of the students at Harvard and MIT also answered incorrectly. So it doesn't matter where you're going to school. Here's another one. This one is a little tougher. During the Vietnam War, a fighter plane made a non-fatal strafing attack on a U.S. aerial reconnaissance mission at twilight. Both Cambodian and Vietnamese jets operate in the area. You know the following facts. A specific case. This is specific to the case. The pilot who identified the aircraft that flew over them identified it as Cambodian. The pilot was tested later for his abilities at recognizing the various aircraft that would be flying over the area. When presented with a sample of fighters, half with Vietnamese markings, half with Cambodian markings, the pilot was 80% accurate in identifying those aircraft and only had a 20% error rate. So pretty good. Base rate data. So this is just general about the area. 85% of the jet fighters in the area were Vietnamese. Only 15% were Cambodian. So the pilot identified it as Cambodian. So the question to you all is, what is the probability that the fighter was Cambodian rather than Vietnamese? So here's the poll. And just answer which one you think is the appropriate number.
Is this a trick question because you said it happened at twilight and so you couldn't see it or something like that?
No, twilight just so that it's easier to confuse, right? And by the way, the test that they did was under the same conditions. Good point. All right, I'm going to end the poll in 3, 2, 1, and share the results here. Okay, so 30% said 80. That's the identification rate that the pilot did during the test. 13% of you said 85%, 35% said 41%, and 22% of you said 15%. So here is the way to answer that question. So it isn't 80. Because so let me walk through this with you. Because 85% of the planes over the area are Vietnamese, the pilot has a 20% chance of misidentifying a Vietnamese plane as Cambodian. That's 17 times out of 100. 80% of the 15% of the Cambodian, that's 12. So we've got a total of 29 aircraft identified as Cambodian, 12 that were truly Cambodian, and 17 that were falsely identified as Cambodian but were actually Vietnamese. So 12 out of 29 is only a 41% correct ID rate. So here again, the issue is our brains try to shortcut these things. I find this is even more problematic when you get into things like health issues. I had cancer about 15 years ago. Luckily, it's all taken care of. Everything's good. But I asked my MDs, and even these guys who I went to somebody who's a national, had a national reputation in the area, and still they could not give me the conditional odds. I said, what are the odds conditioned upon my age, my type of cancer, the staging? No answer. Or they didn't even understand the question. They gave me these unconditional odds. Here's the survivability rate. But they couldn't give me conditional odds. And so they were trained as MDs, not as PhDs, not as statisticians, econometricians. And this question really almost needs an econometrician to think through it and think and have that mindset of a statistician or an econometrician. So again, be very careful when we run into these things. This is called base rate fallacy, that we can easily go with, oh yeah, they identified 80% correctly. Another question for you all. Let me change the poll. Mary is a quiet, studious, and very concerned with social issues. While an undergraduate at Berkeley, She majored in English Lit and Environmental Studies. Given this information, indicate which of the following three cases is most probable. Mary is a librarian. Mary is a librarian and a member of the Sierra Club. By the way, Sierra Club is like an environmentally sensitive group that tries to protect nature and the environment. Or C, Mary works in the banking industry. So just log into the poll and put down your answer. Going to end the poll in 3, 2, 1. All right, there we are. What do you think? I see.
By process of elimination, she works in the banking industry.
Well, and that is correct, and it's the base rate fallacy again. How many jobs are there as a librarian? How many librarians are there that are also members of the Sierra Club, an even smaller subset? How many people work in the banking industry? Huge number of people work in the banking industry. So clearly, again, base rate fallacy. And again, even knowing that there is this base rate fallacy, we still want to answer the other answer. And again, this is just very typical of the way our brains work. We have to prevent ourselves from being taken advantage of by our brains. So when you're an investor, or especially if you're trying to do something like market timing or some sort of technical analysis, some sort of active trading, you can't let your brain just be on its own. You got to leash it in and set some limits. When am I going to sell? When am I getting out of this? Both when it goes my way and when it goes against me. When do I get out? Don't leave that to, it's down, but hey, I know it's got to come back tomorrow. Yeah, not. All right, so, of course, come on, what happened here? As Adam said, she is a banker. Representativeness. These are both shortcuts that our brains use to organize and quickly process large amounts of information. An example of this error in investing is when people confuse a good company with a good investment. Right? There's a famous paper by Lakanishak, Schleifer, and Vishny that find that growth stocks underperform value stocks over 1 and 5 year periods. So you would think that a growth stock, they're going to grow, right? By definition, high PE stocks. The only way you can justify that price is that they're really going to grow fast. Apparently, that price is driven up, not because they're going to grow fast, but because maybe it's a good story stock. You've heard of story stocks. Or maybe it's, a company that's really sensitive to the environment, has really good governance, treats its employees well, but its price is still really right where it should be. Yet people want to buy it because it's a good company. They treat people well. They treat our world well. That drives the price up. That means we're not going to get as good a return. Whereas these value stocks that are low priced, they tend to do better over this 1 and 5 year period that LSV found. All right, familiarity bias, another one of these. Sherwin-Williams is going to be one of those situations for us. So how many of your parents have a locally based company in their portfolio? Is a local company a good investment? And the answer is not always. I always use the example of my dad back when I was, in grade school, bought 100 shares for himself and 100 shares for my mother of this small company called Regal Beloit. RBC was the ticker, or they're still around, so it is the ticker. I don't know. They used to be on the American, so that got bought up. So I'm not sure what exchange they're on now. Why did he buy 100 shares of that? Because it was in our town, the town I grew up in, Beloit, Wisconsin. And did it do well? Yeah, it did fine. It split a bunch of times. They ended up with a couple of thousand shares after the splits. And it amounted to a large fraction of their retirement portfolio. And I kept trying to convince my dad to sell it because why have one company, especially the company in a very small, old industrial town in the Midwest that wasn't getting any bigger, that had lost its two major industries, Fairbanks and Beloit Corporation? And why put all of your eggs in that basket? Well, here was my dad's answer. I'm going to get nailed on the taxes. And I said, you might lose it all if that company goes under. What would you rather do? Get hit on the cap gains tax? By the way, it would have been long term, obviously. So it wouldn't have only been 15%, but he kept going, I'm going to get. He never sold it. Luckily, the company, it had gone down a little bit and then it came back up. But that was just luck. You know, it was not good, sound financial thinking. It was our human brains going, I don't want to lose 15%. Well, you might lose 30 or 40 or 50 or 100 if it's an Enron. All the people who invested in Enron. I lived in near Houston back a number of years back. I don't want to say how many. Okay, 70s, 80s. And Enron was really the talk of the town. If you had a job at Enron, oh man, you had stock in Enron, you were flying high. Those people aren't flying so high anymore. In fact, they're crying because they lost everything. Look at Bernie Madoff. The people who invested in Bernie Madoff thought they were lucky that Bernie would take their money. Well, it turns out that Bernie actually did take their money and spent it on whatever Bernie did before he went to prison. And this is a guy who, prior to running his Ponzi scheme, which now should be called a Madoff scheme, because Ponzi didn't rip off as many people as Madoff did. But before that, he was the president of I believe it was president of the New York Stock Exchange. A guy that you can trust, right? You would think. So, this familiarity bias is easily going to confuse us because we think, I've got a friend who works at Sherwin-Williams and they hear all the good things that Sherwin-Williams is doing, or you name the local company, Eaton, Progressive, Goodyear. I mean, we have some awesome companies in the area. And by the way, those of you that are natives to the area, when we first moved here, I heard a lot of people going, Cleveland, Northeast Ohio is just so down. I'm here to tell you, other parts of the country would kill for what we have here in Neo. Even now, I know that it was much more number of decades ago or when your parents were young, but it still ain't bad. I guarantee you, it's a pretty nice place, not only for companies, but for cultural and just nature, having the national park south of us, having the lake north of us. Pretty awesome place. So familiarity bias, though, can still hit us even in Cleveland. Here's one last question I have for you all. 2 weeks ago, you purchased a ticket for a ski trip to Colorado for $1,800. Yesterday, you got another ticket for a trip to Utah for $950. You think that you'll enjoy the Utah trip more than the Colorado trip, and then you just realized, oh crap, they're on the same weekend and they're non-refundable. I've got to pick one. Which one? And even though I say on the slide, which one do you throw out? Actually, the question I have in the poll is, which trip do you take? So I apologize for my slide question being wrong. Which trip would you take? Colorado or the Utah? You like Utah better, but you paid more for Colorado. 3, 2, 1. There we go. So more of you would do the Colorado, about 60-40, even though you like Utah more, looking at the money, right? Now this question is a little more ambiguous, right? It's not quite a cognitive thing entirely, because you might say, well, gee, I still want to do both trips, and it would only cost me $950 to replicate Utah. I get that. So maybe that's why it's 60-40, not so much just based on the money, but based on, hey, I want to do both trips. Sorry, I didn't share the results. There we go. Oops. Another cognitive type of bias here is this thing called, let me get this out of the way, cognitive dissonance. So cognitive dissonance is where our brain gets information that's conflicting. One of the examples, of course, is that we all think of ourselves as being very nice and very smart. And yet then when there's evidence that maybe I'm not so nice, my brain just goes, oh, wait a minute, partition that off over here because that's just wrong, can't be right, or just ignore it, look the other way. That's cognitive dissonance. This same thing is true. Say we buy a company, we buy a stock, and we hear something bad about that stock, and we go, well, that's just one piece of information. It can't be all that bad. It's really going to be good. So, but the problem is that if we do ignore it, it could be at our peril, right? Evidence that cannot be denied is accommodated by a change in belief. So eventually, maybe we do update, but only begrudgingly, because we really don't want to admit that we're not nice. Cognitive dissonance and investing. So how does that interplay? So here's a survey that was done by a couple of finance researchers. So they asked two questions. What was the return of your mutual fund last year, and by how much did your mutual fund outperform the market benchmark? So if investors are not biased by cognitive dissonance problems, their average recollection of the performance should be equal to the actual performance. I guess you probably have guessed the answer. Investors overestimated their actual return, and they overestimated their return relative to the market benchmark. I want my portfolio to do well. If I see information that it isn't doing well, I just stop looking at it, or I remember it as, that was just a blip. The entire market can be impacted by this as well. So we can think of any gains. So in an up market, we think of that as kind of funny money. People say, well, they're just paper gains. I haven't realized them yet. They're still gains, folks. Still gains. This idea of house money effect, right? You go and you put $100 down and you double it. Oh, yeah, then now I've got $100 to play with. No, you've got $200 now, right? Or 2,000, whatever amounts, however many zeros you want to put on that. So house money effect causes you to take more risks than you would if it was really my money. Well, it is really your money. Overreaction. Many investors assign a probability to asset returns based on past experience and theory. Appropriate reaction to a negative event is to update a prior probability to the most recent event. Overreaction is when they assign too high a value. So we get a piece of bad news preceded by a string of very good news. What are we going to do? Freak out and sell the stock? Well, some people do. So that's how we get these overreactions. I keep moving back and forth, sorry. Hope you're not getting seasick. You want to stay diversified to avoid that sort of thing. Invest for the long term. you get one piece of bad information. It's just one piece. Yes, it's the most recent, but it doesn't mean that the company has gone completely bonkers. Now, 2 or 3 or 4 pieces of additional information, then maybe you've got an Enron on your hands. Mean reversion. Again, sorry. Prices tend to correct themselves. So what goes up comes down. What goes down often comes back up. So that's the idea of mean reversion. Don't buy last year's best performers. What you might want to do is buy last year's worst performers, rebalance. In fact, if you set it up mechanically, there are portfolios. DFA is an example of one, Dimensional Fund Advisors. You can't go out and buy this fund yourself. They're wholesalers. But if you have accounts at various financial planners, brokerage houses, TIAA, CREF, the Teachers Insurance and Annuity Association, groups like that, they give you access to DFA portfolios. What the DFA portfolio typically does is it looks at all the asset classes, and it says basically we're going to take the weight that they make up of the entire economy, and that's what we're going to put into that particular asset class. So is it real estate? We're going to put that into real estate. We're going to put this into stocks. We're going to put this into bonds. And then at the end of each year, they reallocate back to the original weighting. So if real estate went up a lot, all of a sudden it's going to be a much bigger fraction. They're going to sell that back down, and then they're going to reinvest in the asset allocate or the asset categories that went down. So you're effectively selling when prices go up, and you're buying after prices have gone down. Loss aversion, and I'm back to the right. Loss aversion is wanting to avoid recognizing a loss. So you're talking to a friend and you're talking about this stock that just skyrocketed. Do you talk about the stock that fell through the floor? Probably not. Or if you do, you just go, well, I haven't recognized the loss yet. By the way, gentlemen, this is a problem that we face much more than the ladies in the class. There's research that says males are much bigger risk takers and avoid the losses more than females do. I mean, that's fairly well documented research. Again, probably related to the way our brains are set up, but we have a much bigger problem in that area. We don't want to recognize it. And if we don't sell it, we pretend that it didn't happen yet. So we put off selling it too long. And that's why I said earlier on is that what you want to do is set limits. When do I get out, both on the upside and on the downside? That way you know you've got this cognitive bias and you're trying to prevent that from influencing your investing. And then last couple of slides here, I'm not going to go over. I put this slide deck up on Canvas for you all, but these are just some tips for becoming better investors. There's 3 or 4 pages of this. So I think that's it for this. Yeah, there we go at the end of the slides. So any questions, comments at this point? Okay.